Hi, good morning.
Everything good?
How are you doing, my friend?
I'm great. I'm great. Thank you. We have still morning here in Frankfurt, and I just opened my window and saw that it was snowing overnight, so everything is white.
Excellent.
So it looks great indeed. How about you?
It's a beautiful weather in India. I'm in Mumbai right now,
Okay.
and it's getting a little cold. Normally, Bombay is not cold, but it's comfortable. In January, it becomes comfortable. About investing per se, how their perspective is on risk and return. What's running in their mind when it comes to asset allocation? Do they take a lot of risk? Or they take very limited risk and look at a very sizable return. What's their style? So, my dear friends, today we have Dr. Demir Bektic. He's the head of portfolio management at FINVIA. He has also been professor at various universities in Monaco, Dubai, and various other parts of the world. And he's very, very well versed with teaching quantitative capital market research. So, hi, Demir, how are you?
Hey, Abhishek. I'm fine. Thank you very much for having me.
Excellent.
How are you?
I know you teach length and breadth of investing, and you have had a very, very substantial investing experience for the last 15, 16 years. So let me start with Demir. Take us a little bit about your journey. We were mentioning before there about how things changed for you and how the investing style that you follow have actually been because of how you had been brought up and some experiences in your life. So why don't you throw some light on your journey, and then we can straight away get to some questions on investing.
Sure, absolutely. Yeah, well, so in my journey through the realm of the investment world, I draw a lot of inspiration from the diverse landscapes of my life. I was born in Bosnia, and when I was 5 years old, the Yugoslavia war broke out. So me and my parents have to leave our home country, literally with 2 bags of clothes. So growing up in such an extreme environment, financial challenges became the catalyst for my fascination with wealth creation and finance and investments in general, of course. Witnessing the impact of these economic fluctuations on my family was really monumental back then at such a young age, and really ignited this passion for understanding the importance of money from a very young age. So from the very beginning, education and knowledge have been actually crucial for my journey. And later on, my academic pursuits in finance and economics provided my foundation, but it was actually the real world experiences that shaped my approach to investing. And with every stage of my career or with every employer, I actually added always something that I learned, that I liked, and build out my, let's say, unique investment philosophy and investment style. So I think it's really very important to find a investment approach that fits your personality, so you can stick to it and stick with the strategy even when times are hard, right? So nobody has a hit ratio of 100%, and I think this is why this kind of approach is very important. And there's actually one of my favorite sayings about the market. So it goes like, there are a million ways to make money in the markets, but ironically, all of them are hard to find. And this is also something that actually, actually had a huge impact on myself, and made me go a little bit in more to this quantitative area. So I was always kind of a fiend to numbers and systematic strategies, especially also after learning about behavioral biases at the university. And it gave me the possibility to actually test a million of these strategies in order to find some to be profitable, at least to seem profitable. And these lessons from setbacks and triumphs have instilled me in a resilient mindset, emphasizing also the importance of adaptability and also continuous learning in the ever-evolving landscape of finance. And yeah, embracing both, so success and failure as integral parts of the journey, has cultivated a very disciplined and patient investment philosophy.
Risk, return, and asset allocation in your part of the world. In Europe, how do they think? Is there a trend? Is there a home bias? What is it? Tell me a little bit more about it.
Yeah, so I will start with the last point, which is actually really great. So the home bias, usually when clients come to us and we do the initial analysis of their portfolio, there are usually always a lot of local equities. So these are the most famous name from Germany, be it BMW or be it BASF and so on. And the first thing that we actually do is to try to cluster, right? So usually they have one or two industries they are familiar with. They have a couple of stocks. Some are, of course, over-diversified with over 100, but the others are very concentrated. So it's about finding the right balance and the right mix. And indeed, we start with the very first step, which is strategic asset allocation. So how should the asset allocation look like, depending, of course, on the goals of the investor with his or her, of course, corresponding investment horizon. And by doing so, I mean, it's hard to generalize because every client has its own unique needs, right? But if I had to generalize, I would say that the landscape, especially in Europe, has changed a bit. So usually, previously, US investors have been more risk seeking, right? European investors have traditionally been a little bit risk averse, but I think it has changed, especially over the last decade when we had the zero interest rates environment and investors have been forced to reach for yield and go into more riskier assets. And I think that this mindset has indeed changed. So today, when we invest $1 million, I think there would be 50 to 60% equities in the average, let's say, investor's portfolio. There would be still not that much bonds because we had the inflation topics of the last 2 years. But today we have positive real interest rates again, also in Europe. So I think that 20 to 30% fixed income is definitely yeah, important and good because we have these higher interest rates. And then what we are a huge fan of is also mixing a little bit of gold in it, because gold has also provided yeah, low correlation to these previous two asset classes, so about 10%. And then if there is still some space left, we also like to diversify across, let's say, real estate, private equity, private debt, or investors that are not keen or familiar with the illiquid side usually have liquidity in order to have some fresh money if the markets stumble and we can find or identify a good entry point.
But I mean, in India, people are crazy about real estate. You know, our participation in financial markets is still extent of 3-4%, and the rest people still like to own real estate land because it has been growing and compounding very well. You know, what's the scene of real estate in Europe? People are crazy about owning assets, or they like to rent.
Yeah, so the trend here has been actually very similar. I think here with this point, people all around the world are very likely minded when it comes to real estate. All of us want to possess something, right? But it's always a question of time and financing. So the timing is always very important in the markets. So I usually actually used to say that timing is more important than hedging. So this one I always actually use in some meetings. But coming back to your question, I think over the last decade, where we have these, as I mentioned, zero interest rates environment, people were more friendly to buy real estate as the financing was very cheap. But of course, a lot of them did not consider that the prices are actually higher when the financing becomes cheaper, right? It's similar to bonds, the yield and price relationship. And over the last 2 or 3, so we had a really huge boom. If we take Germany, especially here in Frankfurt, where I live and work, it's been really I would say a bubble. And over the last 1 or 2 years, the prices have came down. So they struggle a little bit, but still not that much to be considered a crisis. So we have still very high levels of pricing, although the financing got significantly more expensive compared to 3 or 4 years ago.
Yeah, I was reading yesterday, I think the home prices have fallen down by 10% there, isn't it, in Germany?
Yeah, exactly. That's true. So 10% is roughly a good number.
Yeah. Okay. And when you talk about risk and return per se, how do these people perceive risk and return? I mean, normally in the investing world, too much focus is given on return, and people tend to ignore risk. The risk is only evident once that asset class really falls down by 70-80%, especially equities or small cap equities, etc. So what has been your experience while you're meeting rich investors? How do they look at risk and return?
Yeah, so this is a great question, and it's actually also very diverse. So it's kind of tough to generalize. As for example, I have entrepreneurs that set up a company, managed it, and sold it. So these type of investors are risk seeking. They don't have problems with risk. They also want to have alternative investments, etc. And then on the other hand side, you have some family wealth that you had over generation, that their focus is on protecting, of course, the wealth that they have and make sure the next generation are able to keep it. So these, I would say, two extremes are existent, and this is what I observe every day. So trying to generalize or finding the average, it's always about the unique goals. And what I tell my clients or ask them usually with which kind of risk or which level of risk are you able to sleep well at night? And I mean, there are a couple of questions that one can ask in such a meeting. So do I. For instance, would you rather hold GE or Tesla? So this gives you already a very good sense on how the investor thinks, where their mindset is about the markets, and can then, let's say, categorize in what kind of risk type this investor is in the end. But I'm fully with you. So also, no matter if one of the other of these two extremes, they all neglect the risk side and they all focus on returns. And it's usually, a very one-sided view when talking to clients. And usually we then open a little bit their eyes when it comes to these topics.
And I also wanted to insist that, of course, the track record of European markets, I don't have the exact numbers, but I'm sure it's not as good as US in terms of long-term performance, whether it be NASDAQ or the Dow. I mean, there are bouts when the markets do very well and the bouts when the market just sleep. So is there a trend where people are moving to multi-asset, multi-geography kind of an allocation, or they're still sticking on with a lot of home bias?
Well, actually, what we observe, and also what is our view right at the moment, is that we are shifting away from the US. So the US market has been tremendous over the last decade and built up a huge momentum. The market cap of the Magnificent Seven is going through the roof, right? So no reasonable portfolio construction can work with just 7 stocks. And I think, although we have this hype of AI and that this is going to change our lives in the future for sure, I think the valuations of these specific companies and a couple of others, of course, from that space is really due to overreaction. So we have a hype. And I think that as the higher the markets are, the lower the expected returns, right? This is what we learn. And this is how also we see the market. So the higher the market is, the lower the expected returns, meaning that there is not that much to get over the next couple of years. So we, of course, look at markets where there is something to get over the next couple of years. And we think that Europe, especially, is going to be the good performer compared to the US over the next 10 years. I think emerging markets will again play a more important role, especially after COVID right now. And of course, there are a lot of other important topics right now, like deglobalization, militarization again of the world. But I think that these things on the economic landscape will still be good for the emerging markets. They are getting stronger, the GDPs are rising, right? And also some single countries, but of course they can change from time to time. But this would be the overall allocation on the equity side, or the equity perspective, when talking to clients, for instance.
So Demir, you mentioned about emerging markets. Are we seeing talks among the investing circle with the allocation to countries like India and Japan increasing? And
Yes.
specifically in India, what do you feel about?
Yeah, it's a great example. So I mentioned some single countries, and India is definitely among them. So we have also an overweight in India. We have overweights in Japan, which has also been very good last year. We had the depreciation of the Japanese yen. We have a country which is very strong with exports, so it was fueling the equity markets in Japan, which was very good. India, as I mentioned before, then Korea was also a good market. And 2 years ago, actually, when all of the markets went down in 2022, Turkey was one of the great equity markets to be invested in. So as we have a much larger universe, the possibility of finding a performer is much larger. And it's also quite different when you compare, let's say, the European market, where the markets are highly correlated to each other, and also to the US, which are, of course, the developed markets. So the beta is usually very, very high. We find a lot of diversifying potential when considering also single countries in the emerging market space.
Right. So David, you have a background on quantitative strategies. You have been actively teaching. And tell us some simple quantitative strategies or some formulas that you have in mind, which is easy to understand for the viewers, and which is very simple to understand and very, very profitable in the long run.
Yes, sure. So what I'm a big fan of, and actually this also developed, and this is why I also did my PhD on that topic, is the so-called factor investing, or risk factors investing. I think this is a very, very large topic, and we could talk about this for days only with this, but I'll try to make it very simple and understandable.
With some example, if you can use, that will be so nice.
Right, of course. So also here, the question is, should I just use a factor like, let's say, size, where you focus on smaller companies? Should I just focus on momentum, meaning that companies that have been performing well over the last 12 months? And then we have other factors like quality and value, for instance, that are more well known. But also here, diversification is key. So I would start to incorporate more of these factors. So a handful is good, 4 to 5 factors that are per definition less correlated to each other. So we start with these. Of course, it depends then on how you define a certain factor. There are lots of definitions. How do you do your, let's say, rebalancing, etc. But I think we should exclude these two for a second. And let's say we start with these factors, for instance, equal weighted. So we have 5 factors with 20% weight each, which are today accessible with ETFs that are very cost efficient, that are liquid, and that already provide a very good diversification in itself, right? Because they have multiple titles. And then you start, and after 1 year, you look at your portfolio and make a review, which should always be done, of course, and then see, okay, for instance, my momentum stocks have been performing very good. Value has been very bad. The other 3, let's say, stay more or less the same. So what should you do? Again, also here, sell the winners and reallocate to the loser, in this sense, to also make the allocation back on your initial allocation of an equal weight of, let's say, 20% each. So this is, in a long-term perspective, a very, very good strategy, actually, where you don't have to watch the market every day and to be excited with the noise that you have. You can employ this strategy while having a full-time job. You can employ these strategies for your saving account. And this is also a very, very robust strategy also over the last couple of years or even decades, and also generated risk-adjusted returns that are higher than that of the market, for instance.
Right, right. Would you like to share an example where you used factor investing with a set of stocks or set of multi-assets and it really worked well and it made a killing in your overall portfolio performance?
Sure. So my whole allocation view or process is actually based on factors. So we don't have just factors on the equity side, but we do, of course, have factors in other markets as well. For instance, in fixed income, we have the term premium, which you have usually with government bonds. So this is the duration that you have. And with corporate bonds, you have the credit premium, right? So this is the risk on top of the yield curve that you probably should get in return. So these are the factors on the fixed income side. And when constructing a multi-asset portfolio, we try to diversify among the factors themselves. So it's not just a region versus region or industry versus industry, but we can subsume a lot of these within factors. So for instance, if we have traditional, let's say, defensive stocks, which would, for example, be let's say healthcare, let's say consumer staples, for instance. So we can subsume these two under one factor, actually. Or on the other hand side, you have telecommunication, you have IT, etc. You can also subsume this under one single factor. So unless having, let's say, 10 regions and 20 sectors, you can have a handful of factors where you can manage all of these exposures to build an overall very, very stable and robust portfolio, which also gives you a much better risk-adjusted return, because the factors are usually less correlated than asset classes. So let's say 2008 or 2022, when we have a real meltdown, then usually correlations rise amongst equities, but also fixed income. And this is an issue which I learned back then in 2008. When I started actually then to incorporate these risk factors or factor investing in my overall investment process.
Correct. So, Demir, you have been interacting with people who are in 40s, and you have also been interacting with people in 60s and 20s. Of course, preservation of wealth becomes very relevant for people who are at 60s because they want to pass it on. But what about the 20s? What are you seeing while you're talking to them? Is it all about Bitcoin and alternative asset classes, or is something different?
Yeah, it's also a great question. While the over 60 years olds are all against new things, at least in investing with Bitcoin, etc. in general, of course, the younger generation are more open to it. So I see a lot of Bitcoin trading also in my personal network from friends, but also students. But I think that equity investing is still definitely not dead. So this is still the main domain of investing. But amongst them, it's rather how to find the next hot pick, right? So the next hot thing that is at first sight sure. And this is also what they usually ask. So what would be the best investment? Where should we invest our money? Which 2 or 3 stocks would you buy? So it's then a lot about education again and providing this knowledge that nobody of us actually can foresee future events, but it's rather, and you also mentioned it in the beginning, is it risk averse, how you risk manage, etc. So I would say always it's a risk-controlled environment of how you should invest. So you should maximize your utility where the expected return is, of course, very, very high compared to the risk involved in a single trade. So I think the people or the younger generations today, they are also very open and very interested to new forms of investing, be it some themes, ETFs, for instance, or also alternative investments. They look more, for instance, in watches and in cars. Even these things are getting more and more mainstream. And I think the investment universe compared to 20 or 30 years ago has actually increased significantly and gives us the possibility to have or to add a lot more to our portfolio.
Yes, I remember the sneaker wave which went on.
Yeah.
People were collecting sneakers.
Right.
And high value cars in India, the Lamborghini, Urus, and the world. People used to trade on that in 6 months, and they used to get so depreciating. There was appreciation because they were
Exactly.
in supply for a very long time. And same for Rolex watches and other ones. The second-hand watch market was more bullish because there was no supply. In fact, now also I don't think you get Rolex in India. You have to actually go get into the wait list.
Wow.
That's
Amazing.
the thing. So, any major trends that you're looking at, David, in the next couple of years? See, I was hearing Druckenmiller, and he was saying that at 2022 PE, US markets are damn expensive. At 5-7 extra PE, what you are currently getting is because of the quantitative easing that America, Europe, and the world had the last 7, 8, 10 years. Because of that, the markets are anyways overpriced. So going forward, when this money is going to come out, slowly and steadily, we may not get supernormal returns in equity what people are used to the last 7, 8 years. We have not lost money at all. So I think that's another way by which this equity cult have happened across the world. What do you feel? Is there any new trend or a contra strategy that you are going to work with? I love China. What about you? What is the contra strategy that you would like to work, if not equities or European equities?
Yeah, exactly. So China is a great example. And I think in the mindset of a systematic investor, as I explained, the expected return and the market price relationship is actually very crucial. So I'm a contrarian by nature, right? So when the markets are actually overshooting and very, very high, I actually look for possibilities where to take money off the table. And if markets are in a crash-like scenario, and we've seen a lot of beating in China last year, these markets are getting more attractive, right? So I'm absolutely with you on this one. And I would approach, let's say, at least for this year, it's always hard to make predictions about the future, right? The next year, I'm still cautiously optimistic. Right. So I've been also for the last year. I remember when I saw an analysis in 2021 in December, in 2022, so December 2022, all of the S&P 500 analysts of the major leading banks, etc., have predicted the first negative year for the first time in the last 2 decades, right? When the poll started. And I gave an interview last year in January for a German magazine where I said, I think recession might not even come. And I think in the end, I got right because, of course, there is also luck involved. But usually when markets are too pessimistic, the opposite happens. And the same is also true on the other hand side. So this is what we also know from behavioral finance. So for this year, a lot of people are now very, very optimistic. And I think it's not going to be a very great equity year like before in 2023. This is why I'm cautiously optimistic. The economic landscape presents a lot of challenges, but also holds opportunities for those who are willing to assess risk and make informed decisions. We still face a number of headwinds, right? We have still the topic of inflation. I mentioned deglobalization and the ongoing militarization before, to name a few. And these factors are putting pressure on the consumer spending side, leading to a slower economic growth at first sight. But however, there are also some positive signs that you also mentioned. We have a very strong labor market, and corporate profits are still relatively high. And additionally, central banks are starting to signal that they may also be ready again to lower interest rates, so to ease the monetary policy, which could provide some support to the economy. And as we know, never fight the Fed or central banks in general. So this is why I would still focus on I would say, of course, all asset classes in 2024, but I would include definitely diversification and proper risk management. I would include stocks, bonds, commodities, even real estate. And for those that you mentioned that would like to have a bit more performance, even considering alternative investments. And I would also overweight sectors that I believe are more resilient to economic shocks. For example, the healthcare sector. Performance last year was not that good, but again, here it's very anti-cyclical. So I would prefer healthcare this year and rather maybe be underweight on the technology side, where we have seen a very, very strong trend and overshooting in any dimension that you, I think, analyze investment markets, no matter if it's fundamental, technical, or any other number that you look at. So I would be careful to avoid excessive leverage, right? But also to maintain a healthy cash position. This would give me the flexibility to adjust the portfolio if market conditions get worse. So I think there is a possibility that markets could go back. I don't think that we are going to have a crash, but I think 5 to 10% is definitely in. And as I mentioned, so every outlook is, of course, uncertain, but there are always opportunities in the markets for investors who are willing to do their homework and to take calculated risk.
So, Demir, if I am your client and I ask 15% return from you in the current juncture, which I need in the next 3 years, so 15, it can be 5, it can be 25, on an average 15 in the next 3 years, where would you like to put my $1 million?
Yeah, this one is tough, of course. Here, I would have to throw overboard all of my, let's say, investment beliefs or some of them for sure. For instance, over here, we would definitely have to have a more focused and more concentrated portfolio, right? So the risk-free rate in Europe is now like 3.5%. So we still have a large way to go, which is 12%. I think, of course, stocks would be a crucial part of it. And this would include more offensive stocks, right? It wouldn't be a minimum volatility, a stock kind of portfolio or something like that. So it would be stocks with growth potential, with higher betas for sure. I think I would still stick to gold as a diversifier, but also as a return driver. And I think over here, alternative investment could also provide a boost to investing. And with alternatives, I mean not just private equity, for instance, but also including hedge funds into the allocation.
Right. You know, in India, people don't like 15%.
Why not?
They say 15% is very less. We have an inflation of 5, 5.5, 6. Growth is 7. So 12 is nominal return. Our benchmark gives anywhere between 12 to 14% on long term. People want 20-25 in India.
It's always the question of the benchmark, right? It's always the question of the benchmark that you have.
I know. Yeah. So over in Europe, people are very happy with 8 to 10.
Yeah, absolutely. So a double-digit return is definitely a great performance. Of course, in years like we had last year in 2023, where the market is at 18 or 19, 20%, of course, 15 is a good number. but I think 12, 13% is a decent performance where the clients are in general happy with it.
3 books that have changed and shaped your life?
Sorry, I didn't hear it.
3 books which have shaped your life?
Yeah, definitely. So it's hard to name just 3, but I will try. So I've read tons of books, as you can imagine, also through my academic journey. But I think 3 books that shaped my thinking the most about markets and also about my investment philosophy have been definitely Hedge Fund Market Wizards from Jack Schwager, which was a great book 10, 12 years ago. I really love it.
Yeah.
And it's not just about hedge funds, but it's investing in general, how these managers actually think about markets and approach them and invest. I think later on and more academically, the book Asset Management by Andrew Ang was very fascinating. It's a great reading. I can only recommend it, as also the other one. And I think a book that I've read recently and that also sparked my interest and which I find very, very good, and not only for investing but life in general, was The Joy of Compounding by Gautam Baid, which all really got me.
Yeah, it's a very popular book in India.
I can imagine.
The first and the third is very popular in India.
It's a shame that I didn't came across actually a bit earlier, but I got it as a present from a friend, and I really enjoyed reading it, and I think in about 5 or 6 days I was done because it really fascinated me that much.
Excellent. And my last question to you. You had a difficult childhood, like you were mentioning, and take me a little bit about your spiritual journey and how spirituality helped you to become a better investor.
Sure. So yeah, I will try at least. So the journey of investing and life experiences has been actually a profound catalyst for my spiritual growth as well. The financial markets, with their unpredictable ebbs and flows, have taught me humility and the realization that despite meticulous analysis, some elements remain behind our control, right? So this acknowledgement of the unknown has fueled a deeper sense of humility, but also my childhood that you mentioned, fostering an appreciation for the vastness of knowledge yet to be uncovered. So the journey of investing has taught me that true prosperity encompasses more than just monetary gains. It was never the question of how do I earn the most money, but how wealth creation actually is working as a process. And in tandem with this, so life experiences have provided invaluable lessons in resilience and first of all, adaptability. So qualities essential not only in the face of market uncertainties, but also navigating the complexities of human existence. And witnessing all of these global events like wars, my personal triumphs, but also the adversities, has instilled a profound sense of empathy and I would say interconnectedness. So both definitely shape my profound understanding between myself, society as a whole, the universe, and beyond, right? I must really confess that I'm definitely not a card-carrying member of the 5 a.m. meditation and cold shower club. So my approach to spiritual well-being involves a more gentle awakening. And I think that my pursuit of my spiritual well-being has been actually shaped by a blend of practices and realizations infused with a touch of, as I mentioned, humility, but also a splash of humor.
No, I agree. That was so kind of you. And thank you so much for sharing all the very interesting insights of your life in a very candid way, and all your learnings about portfolio management and asset allocation, about your experiences with your various investors and the academia. I think it was a wonderful conversation. And I thoroughly enjoyed talking to you, and I look forward to meet you sometime, maybe next time when I'm in Frankfurt. I'll give you a shout and we should catch up.